Businesses consume value to create value. Hello, ladies and gentlemen. My name is Daniel Abok, the founder of Kidaftare. Businesses don't magically just create value. They have to consume value to operate. So this is what I'm going to demonstrate today. So on one side you have assets. On the other you have operations. So under operations, they are representative of what happens in operations. So one is the market reward. Two, and operations, there is direct consumption. And finally, there is indirect consumption. Yes. So under indirect consumption, you find, let me use a different color, you find things like rent and salaries. For assets, today we are just going to use the products and cash. So these are going to represent the assets that will be consuming over the operations of the business. So for example, when we say rent and salaries as under indirect consumption, they're indirect because they don't vary as you sell more the business from the business operations. So if you have a warehouse in your business, you're going to pay for rent whether you sell more or you sell less. So regardless of whether the market rewards you more that month than the other month, the rent remains the same for the warehouse. So it doesn't vary one-to-one with the sales. So that's why it's indirect. So in this case, when you're talking about rent, I'm going to use black. So rent represents operations, the consumption and operations. On this side, you have cash representing assets. So you have rent and cash. So operations are going to consume cash. So operations are going to consume cash as represented by rent. So if it's 20,000, for complete recording of rent, in this case, we're going to record the consumption of assets as cash, as represented, and operations as rent. So we're going to record the reduction of cash as an asset and record that reduction on this side of operations as rent. So that becomes complete, recording where the value has reduced and where the value went to. Becomes a complete transaction in accounting. So that's how you record indirect consumption, for example. So next you're going to record direct consumption. So these are the keep doing so these are the products sold. So the products sold are going to be presented under operations. So every time you sell, you're going to record that the products leaving the warehouse for under operations as products sold. So in this case, we have the products sold. And operations. On this other side, you have the products. What others call inventory. So in this case, you're going to lose once more products to operations. Say the products were worth 1,000. So you're going to reduce your assets by 1,000 as a result of the operations. Again, it's a direct consumption because we only consume the products upon selling, upon making a sale. So that's why it's direct. If you don't sell that month, you don't consume a product. So you only consume it when you sell it. That's why it's a direct consumption. So you're going, for it to be a complete accounting transaction, basically you're going to record where the value came from as products and where they ended up as. And they've been recorded, that consumption of products will be recorded under operations as products sold. Some people call it cost of sale. So here you're going to record that products reduced by 1,000 and were recorded here on this side as products sold. So products sold represents the operations having consumed the products worth 1,000. Next, you're going to have under market reward is the sales. So we have sales and operations, and we have cash. Sales, cash, and sales. So for the first time, now operations is going to bring in assets. So operation is going to increase assets. You can see under direct consumption, assets are being consumed. Indirect consumption, assets are still being consumed. So for that operation, so for the operations, the market is going to reward us with cash from using these assets. So if the market rewards us with cash worth 2,000 for losing a product worth 1,000 in that case. So the market values the operations for bringing a product worth 1,000 to them by giving you back 2,000. So the operations record the increase in cash. So the increase in cash. So for the first time, the operations are brought in value. So the value have come into assets as cash worth 2,000, and they have come from sales. So that recording both sides. So where the value came from, where it came from sales, and where it has ended up as in cash, that becomes a complete transaction. So that's how you record. Basically, these are typical operations in a business. This may not be. This basically represents how a business would operate, for example. In this case, if the market rewards the business with more value than was consumed, then the business created additional value from operations. This is why, what I've just demonstrated, this is why profit is not just a number. Profit tells us whether operations transformed value effectively. With that, I'm going to end my episode, my second episode, and hope to see you in the next one. Thank you.